Hello. Hi. Hello. Hiya. Can you hear me?
Good morning.
Hi. Good morning. Hi. Um, okay. I hope I've got some interesting stuff to go on today. This was Tomas's idea. Thank you so much for that. Really appreciate it. Really great timing over the weekend, so I could have a bit of time to think about it. Perfect. Perfect. Couldn't be more grateful. Thank you. So, as always, if you have something that you want to talk about in a future talk, that's really great. Let me know. I'll ask you again at the end if you have anything that you want to talk about. The way I've attempted to structure this is I'll talk for about 10 minutes or so, more or less, on some seasonals, and then I'll kind of open it up for you guys to talk a bit. If we have a bit of time at the end, I want to talk about why I've decided not to sell Money Lion. The stock has done quite well. I'm going to talk about my thought process there, and really not specifically about Money Lion, but it's kind of helpful when you kind of talk about a specific example and we put it on the record so that people can formulate their own opinions over time when they see this video. So I'm going to talk about seasonals. So around this time of the year, there's often I hear people on like CNBC and others as well, saying the seasonals are going to be affecting the market right now and this and that. And I decided to look into some of the seasonals, and I'm going to highlight a few that came to mind. And as I dig around, you'll see a common theme here. And then I'm going to talk about my seasonal, which I think that actually probably mine is better than everyone else's. So anyway, so I'm going to get started here. So the one that I felt that that was quite interesting was you probably heard about this one already, like the January effect. So basically, what this is saying is that there's a lot of the tax loss season that happened in, let's say, in Q4, pretty much. I think if memory serves me correctly, I think that around November time, hedge funds have to have their tax loss season, and then I think that outside the hedge funds, you have until December to do the tax loss season. So there's a lot of selling that happens there, and then in January, people tend to pick up those bargains. So that's one thing that I felt that is kind of interesting, and hopefully you'll have heard something about that. Just let me know if you heard about that. Can you just nod your head if you've heard about? Yeah, cool. Okay. The other one, which I thought was interesting, and probably, joking aside, probably actually works the best, is the Santa Claus rally. And the justification is that people kind of feel happy, and the holiday moods are here, and the people kind of spend a bit more in investing in the future. And I understand that one, and I feel that aside from my one, of course, that I'm going to highlight at the end, I think that probably could work. The problem with a lot of these, and I kind of don't want to give the punchline too early, but the problem with a lot of these is the length of time that they last. Sometimes it can last, let's say, a couple of days. Sometimes it can last a couple of weeks, and it's so fleeting that it's kind of difficult to base anything off that. If it's kind of just it's happening for a couple of weeks, and you kind of it's here, it's happening, and you're dancing and you're singing and dancing, and then it kind of just fizzles out, and you're like, oh man, like a sucker punch. I don't know if you guys ever play chess. Sorry to keep repeating this, but I play a little bit of chess, and if you've ever played chess, the one thing you do not do is in front of your king, you do not put your queen to protect your king, because someone just comes and puts like a rook in front of you or something, and you got nowhere to go because your queen is pinned down. It's like a little sucker punch, It's like in you just don't do that, essentially. But anyway, so I feel that a lot of these seasonals is a bit like a sucker punch, because they kind of shouldn't really get involved with that, and then it's like everyone is doing it and everyone is talking about doing it, and by the time you come to act on it, it's like it just fizzles out. So I feel that, yeah, that's one for me that I felt kind of is interesting, but I just felt as well on the other side of the equation that the problem with that one. Now, here comes some of the ones that I think are more interesting. So the Halloween effect. So the Halloween effect is that stocks wouldn't do particularly well between the month of April and until after Halloween has taken place, and that's normally like the end of October. So there's that period, let's say, of May to October, that's kind of a lull in the market, and you'll see that a lot of these kind of have different names for them. For example, a lot of times in investing, people say, oh, it's a summer months, not much is happening here, people go away, all the hedge funds are away, and there's kind of a lull in the market. So the Halloween and the kind of summer slowdown seems to kind of superimpose on each other. And if you think about it, there's some kind of reason for that, and it's easy to kind of put a little name for that. So I thought that was kind of interesting. And finally, that one that is like the really famous one, which is sell in May and go away, come back on St. Lange's Day. I don't know how to pronounce that. And so I had to kind of Google that one up, and that's St. Lange's Day. It comes from London, when London was a big financial hub. And now I'm going to get to the punchline of why I don't really think these work. These, in my opinion, don't work because the world has become so interconnected that whatever happens in one place really quickly transposes across the market. And these inefficiencies, to a large extent, get arbitraged away. What remains is those black swans. When things kind of like the Ukraine war, it's like, oh my God, like how do I react to that? So there's like some parts of the market go into a bull market, some parts of the market go into a bear market. So, but even in this, just as an example, when there was this whole thing about the Ukraine war, one example I'm going to pick out, everyone's like, cybersecurity is going to go through the roof. Everyone's like jumping on the bandwagon with cybersecurity. And I remember vividly when I was looking for these companies throughout their earnings calls, right after the Ukraine war kicked off, they were all talking about massive demand for cybersecurity products. Massive. All of them were talking about massive demand. The total addressable market was growing, and everyone was like super excited. And the following quarter, there was still some kind of talk about it. And now the time has passed. You can see practically no reference to that whatsoever. So people like to kind of create a story, and the CEOs often like to create a narrative to fit that story. And what happens is that everyone kind of gets really excited about a hyped up thing, but more often than not, it doesn't really transpire to anything, and the market ends up fading that narrative. By fading the narrative, I just mean that people kind of, like in commodities, the cure for high prices are high prices, and the cure for low prices is low prices. The same thing with this kind of cybersecurity. Everyone's like, oh my God, cybersecurity is going to cure all my problems. But anytime that there's these kind of movements towards buying the products from a certain company, there are often, more often than not, plenty of alternatives. And even if they're not alternative, there's a certain price point where it doesn't make economic sense. So when things kind of get hyped up too much, I will now kind of talk about also about AI. When things get hyped up too much, it doesn't mean that they're not going to take place at some point. It just means that you have to think about whether it's already over discounted in the share price of the companies. And I feel that, a lot of that in the market, as we discussed a few times already, I was talking about with you, George, about uranium and stuff like that. And it's kind of like no stock, no idea, nothing in the market ever goes up in a straight line. And I was talking to a very smart investor, and he manages money for some people, and he was saying, "Oh, the biggest trouble I have when I'm investing in the person's capital is when the share price goes up too quickly, because then I have to act. Because if I don't sell a stock, it's like I'm an idiot for not selling it in hindsight, and if I sell it too quickly, he says I just prefer it when the business just kind of compounds away and the share price kind of just performs alongside that, because having to act just because the share price is doing well is like really, really difficult. And I kind of will just momentarily park it there about the seasonals before I kind of talk about this money lion thing. So I'll kind of just open it up if you guys want to talk about the seasonals and have any kind of interesting inputs that you want to talk about.
I guess I have a question about like right now, Hershey's chocolate is because of here it is coming the season, and that's been going down quite a bit because of these new weight loss drugs that they're saying the appetites are going away. So, to me, it'd be tempting to say, oh, this stock is now down 70% or 60%, and now it's seasonable. People are going to buy chocolates and stuff, and I'd want to jump in there and grab it. So, are you basically saying, I sense that you're saying, look, this is a tough target to hit, and you really never know where that storm is, where you're catching it at, and you probably have just as good a chance of missing it as getting it. Is that what I'm hearing from you?
Absolutely, George. I mean, really, really knuckled on. So the problem, there's two problems here. The first one is that in my experience, unless a person has a portfolio, let's say, I don't know, 30 or 40 companies, it's really difficult to have these kind of go for these high risk, high reward stocks. And I speak to a lot of people, man, and a lot of people get really like passionate about these high risk, high reward strategies. And I'm not a particularly good salesman, but I understand the predisposition of investors towards embracing these strategies, because you feel great. It's like, yeah, I had an idea, and you feel vindicated. You put money to work, and it's like you feel great. But the problem is that the first problem here, like for example with Hershey's, I don't know Hershey's, I don't know anything about Hershey's, but I'll just say the first problem here is that you're always comparing with the same period in the same period a year ago. So it's always that comparison thing, and that kind of can cause quite a lot of problems as much as it solves. So every time that there's like Black Friday, you hear that retailers are saying, oh, this time Black Friday is amazing, the best ever. But even if it's up 1% year over year, it's obviously going to be better than the year before, because that's just you comparing. It's obviously going to be the best ever because it was 1% less last year. What you're trying to understand in a business is the stability of it to be able to grow. That's really what's important. And kind of got derailed on my second point. But you want to try your best to, when you're investing, not to just say, oh, stock is down, therefore it's cheap. That can work, but that is difficult. That's really difficult. And I'm not saying that just because something is up, necessarily that is good, right? Not necessarily. I'm not saying like go and buy Nvidia just because it's up. I just feel that it's kind of important to try our best when it comes to investing. And it sounds really boring to say this, but to go back to some basics and think, okay, I am trying to deploy this capital that I've worked damn hard today so that in the next, let's say, 2 years or so, it's worth a little bit more or as much as I put in. And it's all about, we discussed this a few times, all about your expectations. If you come with this expectation that you're trying your best to participate in the growth of the company, not the share price, the growth of the company, what comes afterwards is your reward, okay? Like you know this, we and I talked about this PayPal. You know, I recommended it. It hasn't gone anywhere. Not up, not down. It's only been a few weeks, but anyway, you know, there's all these kind of preconceived biases. Oh, the stock is down. It's so that would be like your Hershey's example. But I'm saying, okay, yes, it is down, but that's not why I'm recommending it. I'm recommending it because I feel that if the business can just continue to very slowly compound, I will get my 10 to 15%. And I'm trying my best to have this kind of expectation of what I'm participating. I'm investing the capital that I've worked really hard for and putting that purchase power into that business because I see that the business can grow it a certain amount. Now, the question mark is how much is it going to grow and what are people's expectations? That's a whole different story, and that's, you know, where the money is made. But if you just start with the basics of what you're trying to do, you're trying to, you know, it's Buffett's rule number one, like I'm trying to invest this capital and allow the business to grow its intrinsic value. And that's really like what we're trying to do. Again, so I gave the example of, you know, Hershey's or Black Friday. So it doesn't really matter too much about what these like headlines are about. Oh, the hype is that people are taking GLP-1, therefore there's not going to be as much demand. Well, I could spin that the other way, right? I could say that because people are taking GLP-1, they feel that they can treat themselves and they can eat more Hershey's. I don't know. Like, I have no idea. I'm just saying that you can spin things, but what's important is just to think about the steadiness of the business. And I'll just kind of pass it to Tomas. Like, do you want to kind of talk about seasonals before kind of move on to other stuff?
No, I believe you answered my questions and we are rather aligned. So there are some phenomena, but they are not that long lasting. And yeah, so it's always best to select high quality business regardless of the time where we are selecting it.
So I'll highlight the one seasonal that I think is actually really interesting, okay? So I tried to write this out and I didn't do a good job. So I'm really grateful, Tomas, that you were able to come here and listen to it because I was kind of, at least I can talk to you and I can express it better than I can write it, okay? So I was, you know, whenever I talk to people, it's like, oh, the business is going to do X amount of cash in 2024. And you're like, okay, yeah, 2024, like you kind of think, it's like, and you say all that until December, and everyone's like, oh, like in 2024, the business is going to do that amount. It's like, yes, okay. But then when the calendar goes forward those few days, and it's the 1st of January, you say, this year, the business is going to do that much. And only a few days have passed, and it's a whole different story. So then investors are not discounting, let's say, a year into the future, that discount rate has come a little bit closer. So, you know, that's why I think a lot of that repricing actually happens is because people are not having to wait as long to get their return on investment. But, you know, this is just, you know, here and there. And I was actually looking at when I wrote when I prepared for this, and in 2022, so now we're 23, so last year. So last year, there was kind of a low period in the market in January. And from January, kind of was like a low, and then things kind of improved slightly into February. And from February into July, the market just soared high, just ripped, which is just contrary to most of the seasonals. So it's one thing to have this idea of what should happen, but there's that expression that in the market, a week can be a long time and 3 months can be a really long time. So if something is not working for you for a really long period of time, like 3-4 months, you're like, whoa, it's really difficult to have the stomach. It's one thing to say, this is what should happen, but from your brain to your stomach is sometimes a really long distance. You know, it's kind of, you say one thing and it's actually to stomach it through is a really different thing. Okay, I kind of talked about that. I'll talk briefly about Money Lion and why I've decided not to sell. So obviously the stock has done quite well for me, and I'm just kind of explaining, you know, what's my thought process here. So obviously, you know, in investing, you're trying your best as much as you can to refine your investment strategy. Whatever is your strategy, if you're buying Hershey, you're buying PayPal, doesn't matter any of your strategies. You're just trying your best to make it repeatable and be very, very honest with yourself. So my thesis was that when people would come to appreciate that this business is not yet another fintech that's burning cash flows, but actually a business can grow at like mid-20s% compounded annual growth rate and can be profitable while doing so, I believe that people will be like, well, this is super exciting, you know, and people can write whatever narrative they want. But the fundamentals need to start. Without the fundamentals, nothing is going to happen. The share price moves on people's expectations of the fundamentals. Okay, so you need, is that quote? I can't really remember, I'm doing a total mess of it, but it's something like, you can fool some of the people some of the time, and you can fool all of the people for a short amount of time or something like that. But you know, you need those fundamentals to continue to deliver for everyone to kind of quote unquote buy into the story. So with MoneyLion, I use the same idea with Broadcom, and I use the same idea with DraftKings. I was looking for an inflection in the business. I was looking for, and that sounds like a really kind of interesting, what does it mean? So I'm just looking to see, beyond doubt, that the business can be significantly more profitable next year than people are giving it credit for. So to make that even like a bit tighter, I'm just trying to buy cheap cash flows from next year. That's really what I'm trying to do. And I use this with DraftKings as well. And incidentally, it hasn't worked out yet, but I honestly believe that HIMS is going to do this as well. So I feel that buying businesses that people have a certain view, like a status quo view of the business. With MoneyLion was like, oh yeah, this is like another thing. Like particularly when it came on the back of this Aiden, this I don't remember how to pronounce it. This ADYEY, ADY or whatever. It's like some European fintech or whatever. So came on the back of that. Everyone was like saying, oh, it's just, there's just too many of these kind of payment solutions, and people are not enchanted with it, and I get it, and you know, Tomas, you and I kind of briefly talked about Stone, the Brazilian one, and I understand, man. Nobody can differentiate these businesses, but ultimately they're really profitable. So yeah, I mean, I understand that that from, unless you're a specialist deep in the water, it's very difficult to say whether the other competitor, PagSeguro, the competitor to Stone, is really that different. And I understand, but ultimately the market kind of recognizes, like, this business is growing its profitability at quite a rapid rate, and provided that, you know, it continues reasonably within that range, it looks cheap. So really, the market, everyone says, oh, the market doesn't get things. The market gets things really, really right. It just sometimes it's kind of 2-3 months where the market goes a bit crazy, but ultimately you're trying to buy these change in a story. You're trying to buy when things are kind of going to get much better, and that's typically that happens reasonably quickly, let's say within 12 months. But when you're investing and things are not working out, 12 months seems like a really long time, and most people haven't got the stamina, and I understand that. And for the record, that's really what I'm trying to do also with PayPal. I'm trying to get here on the inflection, and we'll see how that goes. Yeah, kind of open it up to you guys if you guys have wanted to kind of discuss anything.
I have a question. Natural gas is keeps going down, and it's so weird. I mean, my thoughts, my expectation that it's just getting started to be winter here. Here I'm in Nebraska, it's just getting cold. It's below freezing outside. And so I'm thinking about that stock AR, and I thought, wow, that's going to be what Moneyline's going to do. That's going to double. So I don't know what to say. I don't know what my question is. It's just maybe more of a comment that
Yeah, that's fine.
it's just crazy to me.
Yeah. So from my understanding, looking at what people post on Twitter, the seasonals in America are warmer than normal. So with a mild winter, natural gas is dead in the water. I get that. But yeah, I get that. I get all that. But I'm hoping, and I could be wrong, but my investment thesis is not about whether you need heating or not. My investment thesis is that people need to charge their electric vehicles. But the compound matters for me is that this whole energy transition, this whole, everyone charging their electric vehicles seems to be just dead in the water. It's not really gaining traction, which I understand, and it's a pain. On the other side of the equation, at least with AR and the other ones in the Athabascan Basin and they are profitable. So yes, they're not very profitable. I get that, but at least you're not hemorrhaging blood. Hemorrhaging profit. So you can stick around here, and you never know. It's still kind of the start of winter, so things can still happen. But there is going to be, in my opinion, no, it's not my opinion. I've seen this written by research. There's going to be more demand for natural gas going forward in the summer periods than there is going to be in the winter periods. And the reason is because of global warming, the winters are getting warmer, but the summers get hotter. So you need more air conditioning. Air conditioning sucks up the electricity like there's no tomorrow. And that's not just in the US, that's like around the world, particularly in Asia. And that's really, natural gas gets shipped out from America because it's the cheapest in the world. So it kind of gets shipped around the world. So there is inevitably going to be a drag up in natural gas prices. But I also was hoping that, that it will be a normal winter, because particularly last winter was very mild. So I was kind of hoping that this time around. But I mean, yeah, it hasn't worked out. It hasn't been working out. I don't know how, I kind of been holding on to this investment for quite a while. It hasn't been working out. I probably would wait. I probably would wait a little bit. I'm not going to wait forever, but I probably would wait another 6 months. And if in the summer hasn't been working out, man, it didn't work out. I wish it did. But I'm not coming to investing to try and be smart. I'm trying to make money. I'm trying to make money for people in my marketplace. So I'm really just very focused on, not being there to satisfy my ego, but really just trying my hardest to explain my rationale so you can hold me accountable as well. So you can say, oh, listen, Michael, this is what you've been saying. And there's no kind of ambiguity of, there's no ambiguity. So I'm being very upfront and saying, I believe that in 2024, natural gas would go to at least $4. At the moment, it's 2.9 something or other. And if I don't see it in the next 6 months, by the summer months, it's closer to $4, it didn't work out. There's no point me over intellectualizing things. That's fine. I've seen, and you've seen that when things work really well. There's no point holding on to a cherished idea. When one of my investments works out well, I kind of feel, okay, yeah, we're off to the races. So I don't need to kind of, I want to be patient. I don't want to, I preach for everyone else to be patient. So, I have to kind of stick to my guns. But I feel that, if it's not working out, it's not working out. I've given it enough time. You have to be quite brutal in this game because, when you're trying to invest, what you're trying to do is you're trying to leverage time, really. You're trying to kind of put capital to work today so that it can be more as soon as possible, really. If you want to retain your purchasing power. And if something's not working, man, I've got plenty of ideas that could work. So you have to balance that out, because you're trying your best to be honest with yourself, but you don't want to kind of, sometimes you just have to take a step back as well. But I will wait. It's only starting winter now in a few days. So once we get into mid-January and stuff like that, then I'll get a bit more visibility here. Yeah, we'll see how it goes.
Thank you.
Yeah. I still got a few minutes if you kind of want to ask any other kind of question. Timos, hi, welcome back. Maybe if you wanna kind of, you have some ideas you wanted to share about investing, that you have thought about something?
No, I did want to ask you a question about two specific stocks that you cover. First is Ontario Resources, which of course is being affected negatively by the price of natural gas. Can you comment on that at all?
Yeah, sure. We were literally just discussing that before you came. So essentially, I'll just repeat this briefly. I believe that natural gas would be benefiting from an increase in the use of charging electric vehicles. I understand that the electric vehicles make up a very small amount right now of the global fleet, but my idea was that over time there'll be more and more need for using electricity to charge electric vehicles, and that would displace oil as the primary source of energy. That doesn't seem to be gaining much traction. I honestly hope that it would. The other thing that I'm holding out for, as I mentioned just a second ago to George, is that I know that with the transition to global warming, there's more and more demand for air conditioning rather than heating, particularly in countries that are not particularly affluent, but like in Asia and stuff like that, where they really have more and more disposable income, and they're starting to buy a lot of air conditioning. A lot of that natural gas will be shipped to wherever it's demanded. So I want to, be patient, but I don't want to wait forever. As I was saying before, this business is profitable. So it's not that they are bleeding cash or anything like that. I will just have to wait a few more months. And I'm hoping that with winter, there will be kind of a nudge towards $4 of natural gas price on the spot market. At this moment in time, on the spot market is just below $3. So there's still a lot that needs to go up. If I don't see that in the next 6 months, it gets closer to $4, I'll just say I didn't work out.
All right. I was interested that you did a piece on InterDigital Corporation, which is not too widely followed, but it was picked up about a year ago by Bank of America, which was a positive. The other thing is that it seems to me that their new trying to get some penetration in the video market could be a very huge benefit for them, and the stock certainly is acting well. Can you give me any comments on that stock?
So I don't remember this one off the top of my head. I'll write to you privately.
All right.
Because I know inside out the stocks that I actually own, and I write a lot about the other stocks. If it's a stock that I kind of follow very intimately, I will tell you what I think, but it's not a stock that I follow that closely, and I don't want to speak out of, just.
Well, that brings me to an interesting question I've always wanted to ask you. Is you're just incredibly prolific. How do you have the time to write these pieces on so many various stocks?
So if it's a stock like InterDigital that it's kind of, I've just written about like once or twice, I'm still learning about the business as I go. But if it's a business like, for example, I wrote about DraftKings for a really long time before I recommended that stock. And it takes time for me to get to know the business, for me to be able to say, okay, I want you to invest in this business. And with the benefit of hindsight, you can look back and say, oh, that would have been a really good point. But I'm not trying to recommend a stock when it's like highly risky. I'm trying to recommend a stock when I believe that the risk reward is most favorable. So I'm not, again, to repeat, I'm not looking for those zero to hero investments. I'm looking for something that I feel that the downside is relatively capped. I don't want any kind of big, massive shocks coming into the portfolio. So, like anything, like if you imagine me like a chef in the kitchen, the more you practice making that one dish, you're going to be better at it, but you can't just go and know one dish to open a restaurant. You kind of need to know, a few different styles. So I'm trying to follow as many companies as I can to learn about that business and to keep a track record so that I can follow, okay, this is what I thought, this is how it unfolded. Where was I right? Where was I wrong? And to build on my mental model over time.
One last question, because I know you're about ready to go. Copper. Copper fits into your electrification thesis. So, and it's been, the stocks are down. So what is your best idea, or give me 2 or 3 ideas in that area that I could.
Yeah, so I own and I recommend Tech Resources. And they, like, the reason why I recommend that business is because they have 2 parts. They have the coal business and they have the copper business. The coal business is going to be sold off. That's gone. It's going to go in, I don't know if it's at the end of 2023 or the start of 2024, but that's going to go. So they're going to get about, I think it's about 10 billion. It's like you get 9 billion up front, but then you get the other last billion over the next 12 months, and there's some taxes along the way. So it's kind of close to 10 billion. So they're going to get that as cash, and they're going to pay down and clean up their balance sheet. They don't want to operate debt-free, but they will have a very robust balance sheet where they're going to invest in the copper business. And if you see in the article that I wrote on Tech Resources, you will see there's a nice graph there that shows that Tech Resources is priced at a discount to its peers. So there's 2 aspects here. The business is being spun off is the coal business. They're going to get a cash infusion. With a cash infusion, they pay down their balance sheet. They're going to return probably, I'm hoping, I would love a dividend. I don't know, but they'll return some of that as a share buyback or a dividend. Ideally a dividend, but we'll see. So they're going to return some portion of that. And what's the underlying copper business trades at a large discount to Freeport. And there's also another one called Southern Copper. So these are like 2 big competitors. And they Tech Resources trades at a multiple discount, about 2 or 3 times the discount, the EBITDA to price discount. So just from that, I honestly think that once this is cleaned up, they enter 2024 just as a pure play copper business, they're going to do quite well. I recognize better than most people that this whole energy transition isn't picking up any steam. There's COP26, COP27, all these politicians talking about 2030, there's going to be like the energy transition. Ultimately, the reality is, for one reason or another, it's not picking up. It could be that it's very expensive, the governments have to fund all these solar panels and wind turbines. There's 1,000,001 reasons why it's not working out. Doesn't matter, it's not working out. So copper isn't working out. Upfront and honest, and I own this business, but I own this business because of that second catalyst that I've been waiting a long time for, which is they sold that business. There's going to be a cash infusion. The balance sheet is going to get clean, and maybe there'll be some kind of special return on capital, in the next 12 months.
Thank you.
Okay, I'll wrap it up there. I'm going to write you about InterDigital later on, maybe
Thanks.
tomorrow now. Yeah, thank you very much, everyone, for coming. I really appreciate it. If you guys have any questions, like, drop me a line. I really appreciate it. And I'd like to thank Tomas as well for the content for this one as well today. Thank you, everyone. Thank you. See you soon.
Thank you, Michael.
Thank you so much.
Thank you, Michael.
Thank you.